Hello everyone and welcome back to another video. Today we're going to be taking a look at ETSX, the Evolve S&P/TSX 60 Enhanced Yield Fund from Evolve ETFs. And this fund is going to be very similar to the ESPX fund that I've covered in a previous video, except it's basically going to take what was done with the S&P 500 and ESPX and apply it to the TSX 60 in ETSX. So just like ESPX, it's got covered calls on up to 33% of the portfolio. And if we scroll down here, we can get some more details on the fund. So it has a very competitive management fee of 0.49%. It's got monthly distributions. And if we take a look at the documents here, we can also get a look at the MER, or the management expense ratio. So if we go to the ETFX here, open that up, we'll see the actual MER of 0.71%. So always keep that in mind when you take a look at a fund. You have to look at more than just the management fee, because that is not all the fees on the fund. You want to look at the MER as well. So we can see that there, which is pretty. This is a pretty good fee for a covered call ETF. So we're going to take a look at basically the competition for this fund. So I've identified a few up in the in my browser tabs here. So we have CNCC from Global X, which is their S&P/TSX 60 covered call ETF. They also have a leveraged version of that, so CNCL. And then we have a couple broad-based Canadian exposure ETFs that also do covered calls from BMO. Global Asset Management. We have ZWC, the BMO Canadian High Dividend Covered Call Fund, and we have HLIF, the Harvest Canadian Equity Income Leaders ETF. So what I've done is I've plotted these all inside of Coifin together, except for CNCL, just because its inception date was a little bit later. I have a separate dashboard though for CNCL, so we'll take a look at that in a second. But we can see that ETSX is outperforming the group by a pretty good shot. So I mean, the best comparison, because HLIF and ZWC, they're not exactly tracking the TSX 60. They're looking at high dividend pairs. This one, equity income leaders. It's not going to be exactly the TSX 60, but they're pretty much the same. I mean, here 30 largest diversified Canadian equities versus if we look at here, it's basically just you're gonna have your Canada ETF. You're gonna pick one of these. You're not gonna I'm gonna blend a TSX 60 and a broad-based Canadian ETF. Probably not. So I think it's pretty good to compare them all. But I mean, the most direct comparison is CNCC, because it's literally TSX 60 as well. And ETSX since inception has just been, really doing much better, over 6% better in terms of total performance or total return here. And then we have HLIF even lower and ZWC even lower. So you might be wondering what this could be. It could be the covered call strategy. I think Global X, they rate up to 50% of the portfolio, so that could be one thing, because even CNCC has a lower management expense ratio of 0.5%, which is lower, so you should be paying less and you should be getting more of a total return, but still ETSX is still outperforming it quite substantially. And then with BMO's fund, it's a MER of 0.72%, so basically the same. And then if we take a look at HLIF, go to the ETFX here real quick, it's going to be even higher at 0.79%, HLIF being the highest of the bunch. So ETSX, definitely a very good option out of the bunch. And then what I've found pretty interesting is this fund, CNCL, you'll see on, some people will promote leveraged funds as a way to enhance your yield. You can go from a 8.56% yield with CNCC, you slap on 25% leverage, and you've got 10.56% yield, and everyone will be like, oh wow, I like the sound of that, double-digit yield, and they'll go ahead and buy this this fund and not consider some of some of the other funds. And if we take a look at ETSX versus CNCL, so here you've got 25% leverage applied. So you should have, if the stock goes up 10%, you should be getting a 12.5% return. So you've got that 25% leverage slapped on, and it's still not, on par with ETSX. So that's this is just a testimony to ETSX having, a pretty good setup here. So I definitely like it compared to the competitors. And another thing that I wanted to look at, because, covered call ETF investors, they understand that, total return isn't the biggest thing. So, you're giving up a bit of total return compared to the underlying for yield today. So if we plot it against XIU, for example, you're going to see that ETSX is underperforming XIU, the underlying. It is a decent drag. So, but it's the TSX 60 with no cover calls on it. So, and probably less management fees. So if I look at XIU here, I'm going to take a look. Where is your MER? Let me just look at MER. Oh, here we go, 0.18%. So it's a much lower management fee. So I think that's something that's contributing to it. But obviously your yield is going to be your yield's going to be a bit lower here, but less than 3%. So with ETSX, you've got a yield almost at 9%. So if you're an income investor, I think this is definitely a good option out of the bunch. If you're just pure growth investor, stick with XIU, you're going to do better. But if you want some income, definitely give ETSX a consideration. But one thing I also want to show you was, because I do growth investing as well, so I have like my income version of like for my hybrid portfolio, which is ETSX, and then I have my non-income version, which is just pure growth in VDY. And ETSX is actually outperforming VDY by a little bit since inception. So very tiny, like that's very insignificant. VDY has been outperforming up until recently. I think Canadian energy has taken a bit of a hit just as of recent because of the threat of tariffs and stuff as of making this video. So, but yeah, it's really good to know that like my income ETF ETSX is even performing like on par or even better than my my growth orientated fund for my Canadian equities. So I definitely think if you want to get some exposure to Canadian equity and you're an income investor, or you're a hybrid investor and you want some income exposure, I think ETSX is definitely good fund to consider. And if you own any of these other ETF, the competitor ETFs, definitely take a look at switching to ETSX, because you might be giving up quite a bit of upside for I don't even know what the benefit. If I look at CNCC, it's like the yield's even less than ETSX, so you're getting less yield, getting less total performance. So I would definitely consider switching to ETSX. It's the same as TSX 60, so I would definitely 100% give that I would switch that for sure. HLIF and WC, if you think that the strategy of 30 Canadian companies as opposed to TSX 60 is really doing you better, and you can see the performance doing substantially worse, you might want to consider making the switch as well. So just wanted to share that with you guys, to do a quick overview of this ETF, just a bread and butter ETF, just TSX 60, 33% covered calls, relatively low management fee for a covered call ETF. It's going to underperform the underlying, but it gives you solid yield every month. So definitely give it a consideration, and I'll see you guys in the next one.